If you are an Aussie working hard, paying tax, watching rent climb, and wondering if you will ever crack into the housing market, the 2026 federal budget just changed the game. Treasurer Jim Chalmers has handed down Labor's first full budget since their landslide election win, and this is not a fiddle around the edges. It is the biggest shakeup of the Australian tax system in a generation. Depending on where you sit, it is either the best news you've had all year or a kick in the wallet you did not see coming. First, the headline. Every Australian taxpayer is getting another tax cut from the 1st of July 2026. The tax rate on income between $18,201 and $45,000 drops from 16% to 15%. Then, from the 1st of July 2027, it drops again to 14%. That's worth up to $268 in your first year and up to $536 every year after that. Combine that with the cuts already legislated, and someone on the average wage of $81,245 is keeping $1,978 more of their own money in 2026 to 2027, rising to $2,496 from 2027 to 2028. Think about what an extra $2,000 a year actually does. Drop it into your mortgage and you knock years off your loan, or drop it into an index fund every month to build a long-term asset. There's more. From 2027 to 2028, Chalmers is introducing a brand new Working Australians tax offset. It's permanent, worth up to $250, and it lands in the pockets of more than 13 million Australians. 97% of those workers will get the full amount automatically. This lifts the effective tax-free threshold for working Australians to nearly $20,000. And here's one almost nobody saw coming. From 2026 to 2027, you can claim an instant $1,000 tax deduction on work-related expenses without keeping a single receipt. There's also relief at the Bowser. With global fuel supply disruptions, the government has more than halved the fuel excise from 52.6 cents to 20.6 cents per liter for 3 months. It's temporary, but it means real cash back in your pocket while it lasts. Now, here's where the budget gets interesting, because Chalmers didn't just hand out tax cuts, he paid for them by going after the wealthiest investors in the country. Negative gearing is being reformed. Properties already owned before budget night are completely grandfathered. However, if you buy an established property after budget night, you no longer can deduct those losses against your wages. The full restriction limiting negative gearing only to new builds kicks in from the 1st of July 2027. The message is clear. The government wants investor money flowing into new housing supply, not bidding up the price of existing homes. The capital gains tax discount is also being overhauled. From the 1st of July 2027, the flat 50% discount is being replaced with an inflation-based discount and a minimum 30% tax on gains. In plain English, you'll only pay tax on your real capital gain after inflation is stripped out, but you will pay a fairer rate on what's left. Property investors in new builds get to choose either the old 50% discount or the new arrangements, which is another nudge toward building rather than buying existing stock. The Treasury estimates around 75,000 additional homeowners over the next decade who could not have broken in before will now have a real shot. Let's talk about super. The new Division 296 tax will officially kick in from the 1st of July 2026. If your total superannuation balance is above $3 million, you'll pay an extra 15% tax on the earnings above that threshold. The part the headlines are missing is that this $3 million threshold is not indexed to inflation. A 35-year-old contributing steadily over 30 years has a very real chance of hitting that cap by retirement. On health, there's genuine relief. PBS medicines are now capped at $25 for Medicare cardholders, down from $31.60. Urgent care clinics are being made permanent, and public hospitals are getting record funding. Now for the losers. Rich families using discretionary trusts will face a minimum 30% tax on trust distributions from the 1st of July 2028. International travelers will pay a higher passenger movement charge, lifting from $70 to $80, and anyone on JobSeeker is stuck where they were with no real boost to the $58 a day rate. So, what should you actually do? First, run the numbers on your tax position now and update your budget so you don't let lifestyle creep eat the difference. Second, if you've been sitting on the fence about a first home, the playing field just tilted in your favor as investor demand eases. Get pre-approved and get ready to move. Third, if you own investment property or have large super balances, get professional advice because the strategies that worked for the last decade won't work for the next one. This budget is a transfer of wealth, plain and simple, from older, asset-rich Australians to younger, working Australians. The rules have changed, and your job now is to play the new game better.